Hey, what's up guys? John here. Banks are in very big trouble.
Banking could get in a lot of trouble just because of the kind of things that they did.
Moody's downgrading 10 U.S. small and mid-sized banks.
Wells Fargo, Citi, and JP Morgan, they wrote off nearly $4 billion in bad loans.
Yesterday, the reverse repo market fell by $65 billion. And on the 24th, it fell by $100 billion. What does this mean? We're walking into a liquidity event to the likes of which we've never seen before in American history. We pay attention to what's happening with gold. Why is gold hitting all-time highs? Why are countries accumulating tons and tons of gold?
Central banks last year bought the most gold in 1 year that they've bought since the World Gold Council started tracking this in 1950.
Why are billionaires doing it? Well, you have to pay very close attention and connect the dots to see what's going to happen. We're walking into this massive liquidity event. It's going to be unreal. And when it happens, you want to be positioned for this as best you can. In this video, I'm going to break down exactly what's going on, as well as show you this tweet because it made a lot of very good points. And it's going semi-viral, almost 600,000 views. Pay attention to how this whole thing plays out. Look at what the big banks are doing. You have JP Morgan, Wells Fargo, US Bank, Truist, every bank, Chase Bank, TD Bank just fired 3,000 people. Why? Why are they doing this? Because they know things are about to hit the fan. In this video, I'll break it down for you. Please hit the like button. Hit the like button. YouTube will share this content to educate more people about what's happening in America and the world. And if you'd like to fix your credit to position yourself for this massive liquidity event, because as banks start to tighten up, they're only going to lend to people that are viewed as secure with a good credit score, credit history. Position yourself in the best way possible with great credit by going to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report. Go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for Monday. Take a look at this. So, breaking reverse repo operations today fell by over $100 billion. Money market, mutual funds, and banks use reverse repo to stash cash in highly liquid U.S. Treasury notes. This allows them to receive Fed's funds rate of 0.05% APR in overnight loans in exchange for T-bills and do the opposite the following day. The Fed has implemented new increased initial margin requirements that have raised the minimum capital level required for America's top financial institutions. As liquidity is sucked out of the system by the RRP, this leaves banks with less capital with which to meet margin collateral requirements. This has the potential to cause a fire sale of assets should the banks be margin called by the DTC, OCC, and SCC, and or hedge funds or family offices to which said banks lend shares and cash to be margin called by their prime brokers and banks. We are seeing the beginning of a liquidity crisis. Meanwhile, the Fed has only unwound 10% of their mortgage-backed securities valued at over $2.7 trillion. A housing correction has begun as new home sale prices are down 20% year over year. Existing home sale numbers have collapsed to 2009 levels. Well, correction there. They've collapsed past that. Pending home sales dropped to a record low, even worse than during the financial crisis. We're talking 2001. Right? So this is pending home sales in October dropped to the lowest level since the National Association of Realtors began tracking it in 2001. So probably before 2001. So you start to look at this situation is getting bad. And banks have massive amounts of residential and commercial mortgage-backed securities and value and at risk for the top four banks of over $719 billion. Meanwhile, Goldman has 45% of deposits uninsured by the FDIC, and JP Morgan Chase has 55% uninsured. Now, the FDIC can only cover 1.78% of all deposits. So it doesn't really matter what percentage of this is secured or unsecured, because when things hit the fan, we all know how this is going to play out. The top people up here, they'll probably get bailed out. The rest will be, stuck holding the bag. They're all betting on a federally funded bailout with your money in the face of the possibility of a worst recession, stagflation, and the country has ever seen due to this Ponzi scheme that has been exacerbated by the level of this, money printing bailout given to the institutions in 2020 in response to the collapse of the RRP on September 19, 2019, when the Fed had to take over the repo operations to prevent a full-blown stock market collapse at that time. These are the death thrones of the monetary system Ponzi scheme that will inevitably impact the global economy and all of our finances, even if the invisible at first glance, much like the inflation in the last 2 years. So you start to look at what's going on here. Look at gold hitting $2,090 per ounce. I personally believe even if gold pulls back, in the short term, I think gold over the next couple of years is going to do pretty well. And we will see. We're going to start seeing more and more countries, more people get defensive. And one of the safest ways to do that is betting on, precious metals. So China, massive gold buying spree continues. And this isn't an opinion. Look at what happened to gold during the, right at the great financial crisis, the dot-com bubble, the 1970s. You start to look at these periods, gold held up pretty well. So you have Warren Buffett, Paul Tudor Jones, and Sam Zell all buying gold. So when you pay attention to what's going on with banks, and you see things pretty clearly. So this is employee headcount at these U.S. banks. So you have Bank of America down 1.9%, right? Their entire staff. Morgan Stanley down 2.1%. Wells Fargo 4.7%. Goldman Sachs 5.4%. Now, granted, they probably hired a lot of people in 2020 during this period. So what they're probably going to do is they're going to continue cutting the fat off their branches and off these institutions. And what I believe is going to happen is as we walk into a more and more of a liquidity event, we're going to start seeing a lot of these banks start to lean in to AI, to technology, and they're going to start to reduce their expenses as much as possible because consumers aren't going to have the same amount of money to to service loans, to be able to fulfill on these loans. They're not going to be applying for auto loans like they were, in 2024, 2025, most likely like they were in 2021 or 2020. They're not going to be applying for residential home loans. They're not going to be applying for personal loans, business loans, any of these loans, right? So they're going to want to continue to cut their headcount. And look at Citi, right? Citibank. They're getting ready to, get rid of 10% of their staff, roughly 24,000 workers, right? With this new project Bora Bora, right? I mean, you look at what's happening. TD Bank 2 days ago, they're getting ready to fire 3,000 employees. 3,000 employees. And then you have this, what's fascinating here is this came out October, right? October 19th. They said that the next 5 largest banks cut a combined 20,000 positions so far this year. And at that time, that was, breaking news, 20,000 jobs. But within 45 days of this being announced, you had double that number with Citi and with TD Bank. Now bringing this over to 50,000 jobs. So when you look at what's going on with the reverse repo market, you're going to see what banks are going to continue doing. They're going to continue to cut the fat. They're going to continue to tighten up on lending to the likes in which we've never seen before. I mean, we've seen credit conditions 2008, 2009, banks tightened up, sure. But when you look at what's going on, the amount of risk that they have, the amount of exposure they have to refinance themselves into in 2024, in 2025, in 2026, commercial real estate, I mean, you start to look at these offices nationwide, you start to look at the $2 trillion in corporate debt that has to get refied in the next year. I mean, 2024, right? $2 trillion. Corporations have to refinance this debt. We're walking into an absolute tsunami. Some people think, oh, John, we're going to have a soft landing. We're going to have a soft landing. This is going to be far worse than GFC. Consumers are tapped out. Banks are tapped out. Everything is standing at cliff's edge. That's what's happening right now. I personally think it's going to be one of the best investing opportunities of all time. But if you look at what they're saying right here, when he says that hedge funds could essentially walk in and rug pull this, you have to ask yourself, if you have some of these massive hedge funds sitting on 20, 30, 40, 50 billion in cash, why wouldn't they want to do that? They rug pull the system and they go in there and acquire everything, right? So you start to ask yourself, who would really win, right? Who would really win? It's going to be the big guys are going to get a lot bigger during this whole thing. This is the potential to cause a fire sale of assets should banks be margin called, right? The hedge funds and family offices to which said banks lend shares to be margin called by their prime broker. So we'll see. What do you think about this entire situation? Do you think we're walking into a massive liquidity event? And this is why more people, more investors, more institutions, and more countries are walking towards gold. They're walking towards precious metals. They see the writing on the wall for the US dollar and for the US economy. Let's have a conversation about this. I personally believe we're walking into an incredible investing opportunity. I think we're going to see people make absolute fortunes, but I also think we're going to see a lot of people lose big time. So you got to position yourself. You have to put yourself in the strongest position possible. Make sure you're, in the right business. You are out of high interest rate consumer credit card debt. You have the best credit score possible. You are educating yourself every single day, and you're putting yourself in a position to where you can win. Because 2024, 2025, 2026, I believe the next couple of years, this will be more telling for one's future than everything else. I mean, we're walking into it. By 2027, 2028, I think everything's already going to be set in stone. So have a conversation about it below. And if you'd like to fix your credit, you have maybe late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, you have any negative item on your credit report, do not let it sit there. One late payment can drop your credit score upwards of 180 points and stay in your report for upwards of 7 years. Don't let that happen to you. Don't let one or a couple negative issues on your credit report get in the way of a bright future. Go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session for Monday, and I'll catch you in the next video.